One of the most important decisions in retirement is not how much money you have on the day you stop working. It is how that money turns into dependable income. That distinction matters. A portfolio is a number on a statement. Retirement is a series of monthly needs: food, housing, taxes, insurance, healthcare, transportation, family obligations. The ordinary cost of being alive. The challenge is converting one pool of capital into an income stream that can last as long as you do. That is where many people become confused. They spend decades accumulating money, but very little time learning how money should be distributed once the paycheck stops. They know how to save, they know how to invest, they know how to watch the market. But then retirement arrives and the problem changes. The question is no longer only how do I grow this? The question becomes how do I spend this without breaking the system? That is a very different problem. If you retire with $1 million, that sounds like a lot of money. And it is. But $1 million is not automatically a retirement plan. It is raw material. It must be turned into income. The way you do that affects your security, your flexibility, your risk, your anxiety, your legacy, and the role your investment portfolio must play for the rest of your life. Most retirement conversations begin with a withdrawal rate: 3%, 4%, 5%, maybe higher. Those numbers matter because they tell you how much money you might safely take from a portfolio each year. But a withdrawal rate is only one way to build income. There is another element that many people ignore because it is emotional, controversial, and often misunderstood. Guaranteed lifetime income. That means income that is contractually promised and not directly dependent on whether the market rises or falls next year. Social Security is one form of guaranteed income. A pension is another. An annuity can be another. The word annuity makes some people uncomfortable, and I understand why. The annuity market has many products. Some are simple, some are complex, some are useful, some are expensive, some are sold badly, some are misunderstood by both buyers and sellers. So the goal is not to be pro-annuity or anti-annuity. The goal is to understand the trade-off. That is how I think about every financial decision. Not as ideology, as a set of trade-offs. You give up one thing to get another thing. If you keep all of your money in a portfolio, you keep control, flexibility, liquidity, and potential legacy, but you also keep market risk and longevity risk. If you annuitize part of your money, you give up some control and liquidity, but you may gain a stronger income floor, lower pressure on the remaining portfolio, and protection against outliving that portion of your savings. Neither choice is automatically right. The right answer depends on the system your spending need. Your guaranteed income, your portfolio size, your risk tolerance, your health, your desire to leave money behind, your ability to adjust spending, your psychological need for certainty. This is why retirement income planning is more nuanced than simply choosing a withdrawal rate. Let us start with the common approach. Imagine a married couple retiring at age 65. They have $1 million invested. One spouse receives $2,500 per month from Social Security. The other receives $1,250 per month. Together, that is $3,750 per month. Over a year, that is $45,000 of guaranteed income. Now suppose this couple wants to spend $95,000 per year. That is their retirement spending target. We subtract the guaranteed Social Security income from the desired spending. $95,000 minus $45,000 leaves a $50,000 gap. That gap must be filled by the portfolio. The couple has $1 million. Withdrawing $50,000 from $1 million is a 5% withdrawal rate. That is the traditional portfolio-funded retirement structure. Social Security creates the floor. The portfolio fills the gap. A 5% starting withdrawal rate can work in many historical situations, especially if retirees have some flexibility. If spending can decline over time, if the household can reduce withdrawals during bad markets, and if Social Security covers a meaningful base, then the system can be more durable than the headline withdrawal rate suggests. But in this example, we will be conservative in a specific way. We will not assume spending falls as the couple gets older. We will not assume they reduce spending naturally. We will assume they continue spending the same real amount each year. They take $50,000 from the portfolio every year. That makes the example cleaner, because the portfolio is responsible for a large part of retirement income. This couple may choose a more conservative investment strategy. They may not want a very aggressive portfolio because a large withdrawal must come out every year regardless of market performance. So we assume the portfolio earns a real rate of return of 5.5%. Real means after inflation. This is important because retirement income is not only about dollars, it is about purchasing power. A dollar in retirement must buy food, insurance, housing, and care. If prices rise, the nominal amount must rise or the retiree becomes poorer in real terms. In the example, the couple withdraws $50,000 every year and the portfolio earns 5.5% real. If the market delivers that return steadily, the portfolio can still grow. By age 70, the portfolio might be a little over $1 million. By age 80, it might be around $1.1 million. By age 90, it might be just under $1.3 million over a 25-year retirement. The couple withdraws about $1.3 million from the portfolio, and still, under these smooth assumptions, the portfolio can end around $1.3 million by age 90. That is a powerful idea. They spent more than their original starting portfolio amount and still maintained a similar or even larger level of wealth. How is that possible? Because the portfolio was growing at a rate greater than the withdrawal burden. That is the classic retirement portfolio framework. If growth exceeds withdrawals, the system survives and may even expand. If withdrawals exceed growth for too long, the system weakens. Now, real life is not smooth. The market does not give 5.5% real every year. Like a machine, there are good years, bad years, crashes, inflation shocks, recessions, flat decades, behavioral mistakes, sequence of returns risk. The path matters. If the early years of retirement are bad, the portfolio may be damaged even if long-term average returns are eventually acceptable. That is because the retiree must withdraw money while the portfolio is down. This is why the classic portfolio approach works best when the retiree has flexibility. If markets are strong, spend normally. If markets are weak, reduce discretionary spending. If inflation is high, adjust carefully. If the portfolio is under stress, pause large purchases. Flexibility is one of the hidden assets in retirement. A flexible retiree can take more portfolio risk because they can change behavior. A rigid spending plan requires more safety. In this first strategy, the couple is relying meaningfully on the portfolio. That portfolio must do several jobs at once. It must grow. It must fund the $50,000 annual gap. It must protect against inflation. It must survive bad markets. It must last for an unknown lifetime. It must possibly leave a legacy. That is a lot of responsibility for one portfolio for many retirees. This works perfectly well, but it requires accepting that the market is still a central part of your retirement paycheck. Some people are comfortable with that, others are not. Now let us look at the second structure, the hybrid plan. This plan uses Social Security, an annuity, and a portfolio. The key idea is not to replace the portfolio. The key idea is to reduce the pressure on the portfolio. That is a very important distinction. We are not saying use an annuity instead of investing. We are saying use guaranteed income for part of the spending needs so the remaining portfolio does not need to carry as much income risk. That is a different framework. Before we build the example, we need to define the annuity. The annuity in this example is a single premium immediate fixed annuity, often called an SPIA. This is one of the simpler forms of annuity. You give an insurance company a lump sum. The insurance company promises to pay you a regular income stream. The payments usually begin soon, sometimes a month later, sometimes the next quarter. The payment is based on several factors: your age, your gender, current interest rates, the payout option you choose, whether the annuity covers one life or two lives, whether you add guarantees for heirs, whether you choose inflation adjustment. The insurance company takes on the investment risk and the longevity risk for that portion of the money. Longevity risk is the risk that you live longer than expected and outlive your assets. For a retiree, this is one of the biggest risks because the length of retirement is unknowable. If you knew exactly when you would die, retirement planning would be easier, but you do not. You might die early, you might live into your 90s, one spouse might live much longer than the other. The uncertainty creates the planning problem. A lifetime annuity transfers part of that risk to the insurer. You give up liquidity in exchange. The insurer gives you a promise of income for life. That is the basic trade-off. Now, annuity payout options matter. A life-only annuity pays income for as long as you live, and then payments stop at death, because the insurer does not have to guarantee payments to heirs. This option usually provides the highest monthly payout. The trade-off is simple: higher income, no remaining benefit if you die early. That can feel uncomfortable, especially for someone who wants to leave money behind. A life with period certain option pays income for life, but also guarantees payments for a minimum period such as 10 or 20 years. If you die before the period ends, the remaining payments go to beneficiaries. Because the insurance company is taking on an additional guarantee, the monthly payment is lower than life. Only you give up some income to protect heirs from a very early death scenario. Another option is life with return of premium or cash refund. This means if you die before receiving back at least the amount you originally paid into the annuity, the unused principal is returned to beneficiaries. For example, if you put in $400,000 and receive $150,000 of payments before death, the remaining $250,000 would go to heirs. Again, this lowers the monthly payment because the insurer is providing more protection. This is the pattern. Every extra guarantee reduces the starting income. There is no free feature. A life-only annuity pays more because it protects the heirs less. A refund provision pays less because it protects the heirs more. A joint life annuity pays less because it may have to pay over 2 lifetimes. An inflation adjustment pays less upfront because payments may increase over time. These are trade-offs, not mysteries. Now, interest rates matter too. Insurance companies typically invest premiums in long-term bonds and related assets. When interest rates are higher, insurers can earn more on those assets, so they can often offer higher annuity payments. When interest rates are lower, payouts tend to fall. This is why recent annuity quotes have been more attractive than they were in very low-rate environments. Age matters. The older you are when you purchase the annuity, the higher the payout tends to be because the insurer expects to make payments for fewer years. Gender matters because life expectancy differs. Women generally live longer than men, so payments may be slightly lower for women of the same age under certain structures. Guarantees matter because they change the expected payment burden on the insurer. Inflation adjustments matter because they protect purchasing power but can reduce the starting payout by 15 to 30% or more. In many cases, this is why many retirees choose fixed payments and allow Social Security and the portfolio to handle inflation over time. That may or may not be right, but it is a common trade-off: higher starting income today, less inflation protection in the annuity itself. Now let us put numbers on it. A $400,000 immediate annuity purchased at age 65 in the current interest rate environment might pay around $2,600 per month for a 65-year-old man. On a life-only basis for a 65-year-old woman, it might pay around $2,500 per month. If we add a refund provision, the payout drops. A realistic estimate in the source is around $2,300 per month. That is $27,600 per year. So now we go back to the same retired couple. They are both age 65. They have $1 million saved. They receive the same Social Security benefits: $2,500 per month for one spouse, $1,250 per month for the other. Together, Social Security provides $45,000 per year. Now they take $400,000 of their $1 million and buy an immediate annuity with a cash refund provision. The annuity pays about $27,600 per year. Add that to the Social Security, 45,000 plus 20, 7,600 gives $72,600 of guaranteed income. That income arrives regardless of what the market does. Stocks can fall, bonds can fall, a recession can arrive. The annuity and Social Security still pay, assuming the insurer remains able to meet its obligations and the Social Security system continues as structured. The couple still wants to spend $95,000 per year. Now the gap is not $50,000. The gap is $22,400. That is a very different income problem. Before the annuity, the portfolio had to provide $50,000 per year from $1 million. After the annuities, the remaining portfolio has to provide $22,400 per year from $600,000. The withdrawal rate on the remaining portfolio is lower, and because a much larger portion of the desired spending is now covered by guaranteed income, the couple may be comfortable investing the remaining portfolio more aggressively. In the example, the portfolio earns a 7% real return. This is higher than the 5.5% real return in the first strategy because the portfolio is no longer carrying the same income burden. The couple may be willing to accept more equity exposure or more growth orientation because their basic spending is less dependent on short-term market performance. This is one of the most interesting parts of retirement income planning. A stronger income floor can make the remaining portfolio more risk tolerant. Not because the retiree suddenly loves risk, because the consequences of volatility are lower when the portfolio is not responsible for as much of the monthly spending. That changes the role of the portfolio. In the first strategy, the portfolio is the paycheck gap filler. In the second strategy, the portfolio is partly a growth engine and legacy engine because the guaranteed income floor does more of the spending work. Now let us fast forward. The annuity pays $27,600 per year. Over 25 years, that totals $690,000. The original annuity premium was $400,000 by age 90. The couple has received $290,000 more than the original premium. The longer they live, the more valuable the annuity becomes. That is the core longevity hedge. If you die early, the annuity may not look as attractive relative to keeping the money invested, even with a refund provision. If you live a long time, it can become very valuable. That is how insurance works. Insurance pays off most when the insured event happens. In this case, the insured event is living a long time. Now look at the remaining portfolio. It starts at $600,000. The couple withdraws $22,400 per year. The portfolio compounds at a 7% real return. Under the smooth assumptions, by age 70, the portfolio might be a little over $700,000 by age 80, a bit over $1 million by age 90, about $1.8 million. That is a striking result. Even though the couple annuitized $400,000, the remaining portfolio can grow substantially because the withdrawal burden is low compared with the assumed growth rate. By age 90, the couple has received $690,000 from the annuity. They have received about $1.1 million from Social Security. They still have over $1.8 million invested. And they have spent $95,000 per year throughout retirement under the model. That is the power of combining income floors with growth capital. But again, I want to be clear, real life is not this smooth. The market does not return exactly 7% real every year. Inflation changes purchasing power. The annuity in this example is fixed, so it does not automatically grow with inflation. Social Security usually has cost of living adjustments, portfolio withdrawals can be adjusted, longevity varies, insurance company strength matters, taxes matter, healthcare costs can change. Spending patterns usually change over time. Still, the structure is important. When part of the income is guaranteed, the remaining portfolio can behave very differently. This is why retirement income design matters so much. It is not only the amount of wealth, it is the architecture of income. Now we need to talk about the trade-offs, because if you only look at the projected numbers, you may conclude that the hybrid plan is obviously better. That would be too simple. Every annuity decision requires a mental shift. When people retire with an investment portfolio, many of them unconsciously follow a rule. They want to spend the growth, but they do not want to touch the principal. They want the portfolio to stay intact. They want the balance to remain visible. They want to feel that the money is still there. An annuity breaks that psychology. When you annuitize part of your savings, you are intentionally converting part of your principal into an income stream. The money is no longer sitting in your brokerage account. It is no longer fully under your control. You cannot decide later to sell it and use the lump sum unless the product has specific features, and simple immediate annuities generally are not designed for that. You have exchanged a pile of liquid capital for a stream of contractual payments. For some retirees, that is comforting. For others, it is very uncomfortable. This is not irrational. Control has value, liquidity has value, optionality has value. A large portfolio balance gives a person choices. They can pay for medical needs, they can help children, they can buy a home, they can adjust spending, they can leave a legacy, they can change investment strategy, they can respond to unexpected events. An annuity reduces that flexibility for the annuitized portion. That is the price of certainty. This is the main trade-off: control versus certainty, liquidity versus guaranteed income. Legacy versus longevity protection. There is no way to escape the trade-off. You can only decide how much of it you want. Now, inheritance is another major issue in the example. The annuity includes a refund provision that protects heirs if the couple dies before receiving back the original $400,000 premium. But even with that protection, the structure is not the same as keeping the $400,000 invested. If the couple dies early, heirs may receive less under the annuity approach than they would have if the full $1 million had remained in the portfolio and performed well. If the couple lives a long time, the annuity can pay far more than the original premium and may protect the retiree from outliving assets. That is another trade-off. The annuity improves the retiree's long life scenario. It may reduce the heir's early death scenario. This is why annuities are not only financial products, they are tools for allocating risk between the retiree, the insurer, and the heirs. If your top priority is leaving the maximum possible inheritance, a simple annuity may be less attractive. If your top priority is making sure you never run out of income, it may be more attractive if you care about both. You might annuitize only part of the portfolio. That is why partial annuitization can make sense. You do not have to choose all portfolio or all annuity. In the example, the couple annuitizes $400,000 out of $1 million. They still keep $600,000 invested. That creates a blend. Some certainty, some liquidity, some guaranteed income, some growth, some legacy potential. This is often how good retirement income design works. Not as one extreme, as a combination of tools. Now, inflation deserves special attention. The annuity in the example is fixed. It pays $27,600 per year. That is powerful in the early years because it creates a steady income floor. But over time, inflation can reduce the real purchasing power of that fixed payment. A $27,600 payment at age 6, the fifth of may not buy the same amount at age 85. That is a risk. You can buy inflation, adjusted annuity features in some cases, but they usually reduce the initial payment significantly. In the source, inflation protection can reduce the starting payment by 15 to 30% or more. That is another trade-off. Higher income now, or lower starting income with better inflation protection. Many retirees choose fixed annuities because they prefer the higher starting payment while relying on Social Security cost of living adjustments and portfolio growth to handle inflation over time. That can work, but it must be understood. A fixed annuity is not a complete inflation hedge. It is a longevity and income floor tool. If you use it, you still need a plan for rising costs. That is why keeping a portfolio matters. The portfolio can grow, Social Security may adjust, spending may change. A fixed annuity alone cannot solve every problem. No single tool can. Now, the hybrid plan has another interesting psychological benefit. When retirees know that most of their spending is covered by guaranteed income, they may feel less pressure to react emotionally to market downturns. This matters because behavior is one of the biggest risks in retirement. If a retiree depends heavily on portfolio withdrawals, a market decline can create panic. They may sell low, they may cut spending too much, they may abandon a reasonable allocation, they may become overly conservative at exactly the wrong time. But if the guaranteed income floor covers most expenses, the retiree may be able to leave the portfolio alone during downturns. That behavioral stability can be valuable. It may allow the portfolio to stay invested more aggressively and recover more effectively after market declines. This is one reason the hybrid portfolio in the example can use a 7% real return assumption. The annuity and Social Security reduce the income pressure. The portfolio is freer to pursue growth. That does not mean retirees should become reckless. It means income structure affects risk capacity. Risk capacity is different from risk tolerance. Risk tolerance is how much volatility you feel comfortable with. Risk capacity is how much volatility your financial plan can survive. Guaranteed income can increase risk capacity for the remaining portfolio because the portfolio is less responsible for essential spending. That is a major planning insight. Now, let us compare the two approaches more directly. The first approach keeps the entire $1 million invested. It uses Social Security plus portfolio withdrawals. The portfolio fills a $50,000 annual spending gap. The assumed real return is 5.5% because the couple invests more conservatively. By age 90, under smooth assumptions, the portfolio is around $1.3 million. The couple has withdrawn about $1.3 million from the portfolio. This approach preserves liquidity and control. It may leave a strong legacy. It depends more heavily on market performance. It requires comfort with withdrawals from the portfolio. It works best when the retiree has flexibility and can tolerate market risk. The second approach uses $400,000 to buy an annuity. The remaining portfolio is $600,000. Social Security plus annuity produces $72,600 of guaranteed income. The portfolio only fills a $22,400 gap. The assumed real return is 7% because the remaining portfolio can be invested more aggressively. By age 90, under smooth assumptions, the portfolio is about $1.8 million. The annuity has paid $690,000. The couple has received about $1.1 million from Social Security. This approach creates a stronger income floor. It reduces portfolio withdrawal pressure. It may allow more aggressive growth allocation in the remaining portfolio. It sacrifices liquidity and control over the annuitized portion. It may reduce inheritance if death occurs early. Though the refund provision helps, it becomes more valuable the longer the retiree lives. These are not moral choices. They are design choices. The right answer depends on what problem the retiree is trying to solve. Now, I want to make one thing clear: a portfolio only strategy is not reckless. It can be excellent. Many retirees do very well using Social Security plus a diversified portfolio and a flexible withdrawal system. If they have enough assets, a reasonable withdrawal rate, good behavior, and flexibility, they may not need an annuity at all. They may prefer liquidity. They may prefer leaving assets to heirs. They may prefer managing the portfolio. They may have enough margin that longevity risk is not a major concern. For them, an annuity may add less value at the same time. An annuity strategy is not foolish. For retirees who are worried about outliving money, who need stronger income certainty, who have limited pensions, who are uncomfortable relying fully on markets, or who want to reduce the pressure on the portfolio, an annuity may be useful. The problem is when people turn this into identity. Some people say annuities are always bad. That is wrong. Some people say annuities are always safe and perfect. That is also wrong. The correct view is that annuities are tools. A tool is good or bad depending on the job. A hammer is useful for a nail and useless for a spreadsheet. An annuity is useful for certain income and longevity problems and less useful for others. That is the balanced view. Now, there are several questions a retiree should ask before annuitizing any money. How much guaranteed income do I already have? Social Security, pension, rental income, other contractual income. If guaranteed income already covers most spending, an annuity may be less necessary. If guaranteed income covers only a small part of spending, an annuity may be more useful. How much do I need to spend? Not what I wish I spent. Not what a rule of thumb says, actual spending. Essential spending, discretionary spending, healthcare, taxes, travel, housing, family support. The spending target determines the income gap. How much of the spending gap should be guaranteed? Some people want only basic needs guaranteed, others want most of their lifestyle guaranteed. The more you want guaranteed, the more capital may need to be annuitized or placed into other income, floor assets. How much liquidity do I need if you have large uncertain expenses, medical concerns, family obligations, or a desire to maintain flexibility? Annuitizing too much can be dangerous. How important is legacy? If leaving assets to heirs is a major goal, you may want to annuitize less or choose refund or period certain features, even though they reduce income. How long might I live? You do not know. But family history, health, lifestyle, and spouse age matter. Annuities become more valuable when longevity is high. Can I tolerate market volatility? If market declines create anxiety and poor decisions, a stronger income floor may protect the plan psychologically. What is the quality of the insurer? The annuity promise is only as good as the insurer's ability to pay, plus state guarantee protections within limits. This is not the same as a U.S. Treasury guarantee. Insurer strength matters. What are the fees and surrender terms for a simple SPIA? The structure is relatively straightforward, but every contract should still be understood before signing. These are the real questions, not are annuities good or bad? That question is too crude. Now, there is also a timing question. Annuity payouts are higher when interest rates are higher. If rates are high, an annuity may look more attractive. If rates are low, the same annuity may pay less. Age matters too. A 65-year-old gets one payout. A 70-year-old may receive a higher payout because the expected payment period is shorter. This means annuitization does not have to happen all at once. Some retirees may ladder annuity purchases. They may buy one portion at 65, another at 70, another later. This can manage interest rate risk and longevity planning. That idea goes beyond the source example, so I will not make it central here, but the principle is consistent. You do not have to make every retirement income decision on day one. The key is to understand the levers. Now let us talk about the mental discomfort of spending principle. A portfolio creates a visible balance. People like visible balances. They like seeing $1 million remain $1 million, even if the plan says they can spend from it. Emotionally, they may feel that spending principle is failure. An annuity forces a different model. You stop thinking about that portion as an account balance. You think about it as income. This can be liberating or uncomfortable for someone who hates seeing their portfolio decline. An annuity may help because the spending comes as income. The psychological burden of selling shares may decrease for someone who values seeing and controlling every dollar. The annuity may feel like a loss of agency. Neither response is irrational. They are different temperaments. Retirement planning must respect temperament. The best plan is not only mathematically sound, it must be emotionally sustainable. If a plan causes panic, the retiree may not follow it. If a plan gives too little flexibility, real life may break it. The good plan balances math and human behavior. Now, let us discuss spending patterns. The source makes an important point that many retirees spend less as they age. The early retirement years may include travel, hobbies, home projects, and active lifestyle spending. Later years may involve less travel and lower discretionary spending, though healthcare can rise. If spending naturally declines, portfolio withdrawals may also decline. That can make both strategies stronger. In the first strategy, reduced spending lowers the $50,000 portfolio gap. In the second strategy, reduced spending may lower the $22,400 portfolio gap even further, allowing the remaining portfolio to grow more. This is why the example may be conservative by assuming constant spending, but not everyone's spending declines. Healthcare, long-term care, family support, housing, or inflation can increase costs. So assumptions matter. A good retirement plan should test multiple spending paths: level spending, declining real spending, high healthcare costs, long life, early death, poor market returns, high inflation. The answer can change under different conditions. That is why a single projection is not a plan. A projection is a picture. A plan is a system that can handle different pictures. Now, one of the most important concepts here is the income floor. An income floor is the amount of income that arrives regardless of the market: Social Security, pension, annuity, certain guaranteed sources. The higher the income floor, the less your basic life depends on market returns. This can be powerful. If your essential spending is $60,000 and your guaranteed income is $55,000, the portfolio only has to cover a small essential gap. That gives you flexibility. If your essential spending is $60,000 and guaranteed income is $25,000, the portfolio carries much more pressure. This is why the question is not just how big your portfolio is. The question is how much pressure your portfolio carries. A $1 million portfolio with a $20,000 spending gap is very different from a $1 million portfolio with a $70,000 spending gap. Same portfolio, different risk. The annuity in the example changes the pressure. It moves the portfolio from filling a $50,000 gap to filling a $22,400 gap. That is a structural change. That is why the remaining portfolio can compound more freely. Now, what about legacy? Legacy is not only a financial goal, it is emotional. Some people deeply want to leave money to children, grandchildren, charities, or causes. Others care more about not being a financial burden and having income certainty. Neither is wrong. But you must be honest about your priority. If legacy is very important, you may lean toward keeping more assets invested. If lifetime income security is more important, you may lean toward annuitizing some assets. If both matter, you may use partial annuitization with refund features and keep a portfolio. That is exactly what the example shows. The refund provision helps protect heirs if death occurs early. The remaining $600,000 portfolio preserves legacy potential. The annuity provides income floor. That is a blended solution. The trade-off is that the annuity payment is lower than life, only because of the refund provision. Again, no free lunch. Now, inflation and legacy interact too. If the annuity is fixed and inflation rises, the real value of the annuity declines over time. That may push more pressure back onto the portfolio later. If the portfolio grows well, that may be manageable. If the portfolio underperforms, it could be harder. So a fixed annuity should usually be paired with some assets that can grow. That is what the hybrid plan does. It does not annuitize the entire $1 million. It keeps $600,000 invested. That is important. If someone annuitizes too much, they may lack inflation protection and liquidity. If someone annuitizes too little, the income floor may not solve the problem. The sizing matters. Now, the example uses $400,000 out of $1 million. That is 40%. Is 40% always right? Number it is an example. Some people might annuitize 20%, some 30%, some none, some more. The right amount depends on how much guaranteed income is needed to cover essential or desired spending. You can think about it this way. Start with spending, subtract Social Security, subtract pensions. Look at the remaining essential gap, decide how much of that gap you want guaranteed. Then consider how much annuity income would be required and what premium would purchase that income. This is a planning process, not a product. First process. Do not start by asking, should I buy an annuity? Start by asking, what income problem am I trying to solve? Then ask whether an annuity is the right tool for that problem. That is a better sequence. Now, let us return to the first portfolio. Only strategy, it may have more liquidity and control. If the couple experiences a major unexpected expense, the full portfolio remains accessible. If they want to help children, they can. If markets perform strongly, they keep all the upside. If one spouse dies early, the remaining assets are still in the portfolio. If they change their mind, they can adjust. That flexibility is valuable, but the portfolio-only strategy also leaves them more exposed to sequence risk and behavioral risk. If markets crash early, withdrawals continue. If the couple panics, they may sell low. If inflation rises, withdrawals may need to increase. If they live longer than expected, the portfolio must last. If they overspend, the plan can weaken, so portfolio only is not free of trade-offs. It is a high-control strategy, but it requires ongoing discipline. Now, the annuity hybrid strategy reduces some of that pressure but introduces other risks. The $400,000 is no longer liquid. If they need that money for a large unexpected event, it is not available in the same way if they die early. The heirs may not benefit as much as they would have from a strong investment portfolio, though the refund provision protects part of the premium. If inflation is high, the fixed annuity loses purchasing power. If interest rates rise after purchase, they may wish they had waited. If they regret the contract, it may be difficult or impossible to reverse. So hybrid is not free of trade-offs. Either it is a high certainty strategy, but it requires giving up control. That is the decision. Not good versus bad. Control versus certainty. Now, one of the most powerful effects of guaranteed income is that it can reduce fear. Fear matters. A retiree who fears running out of money may underspend even if they have enough. They may live smaller than necessary. They may avoid travel. They may avoid helping family. They may avoid enjoying retirement because the portfolio balance feels fragile. If guaranteed income covers most spending, that fear may decline. They may spend more confidently. That can improve quality of life. Money is not only about the ending balance at death, it is also about using resources to live well. A plan that leaves a huge legacy but causes the retiree to live in unnecessary fear may not be optimal. On the other hand, a plan that maximizes spending confidence but leaves no flexibility or legacy may not fit someone whose family goals are important. Again, the trade-off must match the person. Now, how should retirees evaluate the annuity payout? The quoted payout is not the same as an investment return in the ordinary sense. An annuity payment includes several components: return of your own principal, investment return earned by the insurer, mortality credits, which come from pooling longevity risk among many annuity buyers. Those who die earlier help fund payments for those who live longer. That is how insurance works. This is why annuities can provide higher lifetime income than a bond ladder in some circumstances, especially for long-lived retirees. The insurer is not simply paying interest, it is pooling life expectancy. That pooling creates value for those who live long, but it also means early death can produce a less attractive outcome, depending on guarantees. Understanding that mechanism is important. An annuity is not magic yield, it is risk pooling. It converts uncertain lifespan into a contracted stream of income that can be very useful, but only if the retiree values the risk transfer. Now, there is a misconception that annuities always destroy inheritance. That is not always true. A life only annuity may end at death and leave nothing from that contract, but period certain or refund provisions can protect heirs. The trade-off is lower income. In the example, the refund provision means that if the couple dies before receiving back the $400,000 premium, the remaining principal goes to heirs. That softens the inheritance concern, but it does not make the annuity identical to an investment portfolio. The heirs may still receive less if the portfolio would have grown strongly and the retirees died early. So the inheritance issue is reduced, not eliminated. This is why people must read the contract and understand the payout option. The word annuity is too broad. The details matter. Now, another misconception is that annuities are always too expensive. Some are expensive and complex, but a simple immediate fixed annuity can be relatively transparent compared with more complicated deferred or variable products. The question is whether the payout is competitive, the insurer is strong, the contract matches the need, and the retiree understands the trade-off. The wrong product can be bad. The right product in the right amount for the right person can be useful. This is why the conversation matters. Now, let us think like a system designer. Retirement income can be organized into layers. The first layer is guaranteed income, Social Security, pension, annuity if used. This layer covers baseline spending. The second layer is investment portfolio withdrawals. This layer covers the gap discretionary spending, inflation adjustments, and long-term growth. The third layer is reserves and flexibility, cash short-term assets, the ability to reduce spending, the ability to delay large purchases. The fourth layer is legacy capital, assets intended for heirs or future needs. When the first layer is strong, the second layer can take more risk. When the first layer is weak, the second layer must be more cautious because it is funding more of the essentials. That is the key retirement income principle. The role of the portfolio depends on the strength of the income floor. This is why two households with the same $1 million can have very different strategies. One household has Social Security plus a pension that covers most expenses. The other has only Social Security and a large spending gap. The second household needs the portfolio to be more reliable. The first household may be able to let the portfolio grow more aggressively. Same portfolio size, different income floor, different risk capacity. Now, if you are approaching retirement, the practical process is this. Calculate desired spending, separate essential spending from discretionary spending. Calculate guaranteed income sources, Social Security, pensions, existing annuities, rental income if stable, though rental income has its own risks. Subtract guaranteed income from essential spending, that is the essential gap. Then subtract guaranteed income from desired spending, that is the lifestyle gap. Now ask how much of each gap should be covered by the portfolio and how much by guaranteed income. If the portfolio must cover a large essential gap, you may want a more conservative allocation or more guaranteed income. If guaranteed income covers most essentials, the portfolio can be more flexible. That is the planning framework. Then look at legacy and liquidity needs. Do not annuitize money you may need for large unpredictable expenses. Do not keep everything liquid if the fear of running out of money causes you to underlive retirement balance. Now, what are the major risks in the portfolio? Only approach, market risk, sequence risk, longevity risk, behavioral risk, inflation risk, overspending risk. The portfolio may do well, but the retiree must manage the path. What are the major risks in the annuity hybrid approach? Liquidity risk, inflation risk on fixed payments, insurer credit risk, regret risk, potential reduced inheritance, product selection risk. The annuity may do its job, but the retiree must accept the loss of control. Again, risk does not disappear. It changes form. That is one of the most important principles in finance. You do not eliminate risk, you transform it. A portfolio transforms longevity risk into market and withdrawal risk. An annuity transforms liquidity and legacy into lifetime income. The question is which risks you are willing to hold. Now, the example shows that the hybrid plan can produce a larger ending portfolio under the assumptions, because the remaining portfolio can grow at a higher real rate and withdrawals are smaller. But do not overinterpret the result. The 7% real return is an assumption. If the aggressive portfolio underperforms, the ending balance may be lower. If the portfolio only plan earns more than 5.5% real, it may do better. If inflation damages the fixed annuity's purchasing power, the portfolio may need to cover more later. If the couple dies early, the annuity's advantage is smaller. If the couple lives very long, the annuity becomes more valuable. So the conclusion is not that the hybrid plan always wins. The conclusion is that the structure of income can change the entire retirement outcome. This is why you must model multiple scenarios, not one smooth line. Now I want to talk about the emotional word guarantee. People love guarantees because markets are uncertain. But a guarantee is only as strong as the institution making it and the contract defining it. Social Security depends on the government and future policy. An annuity depends on the insurance company and the contract terms. A pension depends on the employer or pension system. A treasury bond depends on the government's ability to pay in nominal dollars. Different guarantees have different strengths. Do not treat all guarantees as identical, but guaranteed income still has value because it reduces uncertainty compared with relying entirely on markets. The key is to understand the source of the guarantee. Now there is also a tax dimension. Annuity payments can have tax treatment depending on whether the annuity was purchased with qualified retirement money or after-tax funds. Portfolio withdrawals have different tax consequences depending on account type, capital gains, dividends, and retirement account rules. The source does not go deep into taxes, so I will not add a separate tax plan here, but in real life, taxes matter. Net spendable income matters more than gross income. A $27,600 annuity payment and a $22,400 portfolio withdrawal may not have identical tax treatment that affects planning. This is why retirement income decisions should be made with tax awareness. Now, let us discuss why some people resist annuities. They do not like giving money to an insurance company. They fear dying early. They fear losing control. They fear being sold a bad product. They want to manage money themselves. They want heirs to receive everything. Those concerns are legitimate. An annuity should not be forced on someone whose priorities are liquidity and legacy. But other retirees resist annuities because they do not understand longevity risk. They assume their portfolio will last because the spreadsheet says it should. But if they live 30 or 35 years, if early market returns are poor, if spending is too rigid, or if inflation is high, the portfolio can become more vulnerable. For them, guaranteed income may provide real value. This is why the decision must be personal. A product cannot know your priorities. A model cannot know your sleep quality. A rule of thumb cannot know your fear of running out of money. You have to know yourself. Now let us return to the key question. With $1 million at retirement, which pays more, the portfolio or the annuity hybrid? Under the assumptions in the source, the hybrid structure produces a very strong outcome. It creates $72,600 of guaranteed income, reduces the portfolio withdrawal need to $22,400, allows the remaining $600,000 to invest more aggressively, pays $690,000 from the annuity over 25 years, and still leaves a large portfolio by age 90. But the portfolio-only structure also works under the assumptions. It covers the $50,000 gap, grows at 5.5% real, pays out $1.3 million over 25 years, and still ends near $1.3 million. Both can work. The difference is not simply which pays more in a smooth projection. The difference is how the risk is distributed. The portfolio-only plan keeps control but relies more on markets. The hybrid plan gives up some control but creates more certainty. That is the real decision. Now, how would I think about it as a principle? If you have enough guaranteed income to cover your essential expenses and you are comfortable with market volatility, a portfolio-only strategy may be appropriate. If your portfolio must cover a large portion of essential spending and you fear outliving assets, partial annuitization may be worth evaluating. If leaving a maximum legacy is the dominant goal, keep more assets invested and liquid. If personal spending security is the dominant goal, strengthen the income floor. If you value both, consider a hybrid. If you do not understand the annuity contract, do not buy it. If the annuity is complicated, expensive, or sold with pressure, be cautious. If the annuity is simple, competitive, and directly solves an income problem, it may be useful. That is the balanced view. Now, a final important point: retirement is not one decision made once. It is a sequence of decisions: claiming Social Security, asset allocation, withdrawal rate, spending flexibility, Roth conversions, tax planning, insurance, long-term care risk, annuity decisions, legacy planning, cash reserves, investment management. Each decision affects the others. If you strengthen the income floor, you change the portfolio's role. If you keep the full portfolio liquid, you change the need for spending flexibility. If you delay Social Security, you may increase future guaranteed income. If you buy an annuity, you reduce liquidity but reduce longevity risk. If you spend less in later years, the portfolio may last longer. This is why retirement planning must be integrated. The annuity decision cannot be made in isolation. It is one part of the whole system. Now let us bring the structure together one last time. A couple retires at 65 with $1 million. Social Security provides $45,000 per year. They want $95,000 per year. The portfolio-only strategy requires the portfolio to provide $50,000 per year. That is a 5% withdrawal rate, assuming 5.5% real return. The portfolio can still grow over time in the example and end around $1.3 million by age 90. The hybrid strategy uses $400,000 to buy a fixed immediate annuity with a cash refund provision. The annuity pays about $27,600 per year. Guaranteed income rises to $72,600. The portfolio now only needs to provide $22,400 per year from the remaining $600,000. Because withdrawal pressure is lower, the portfolio can potentially be invested more aggressively. Assuming 7% real return, the remaining portfolio may grow to around $1.8 million by age 90. The annuity pays $690,000 over 25 years. The longer the couple lives, the more valuable the annuity becomes. But the couple gives up liquidity and control over the $400,000. That is the trade. Not one obvious answer. A trade. Now, the final principle is this: the stronger your income floor, the less pressure your portfolio carries. The less pressure your portfolio carries, the more freedom it may have to grow. But the more income you guarantee through annuitization, the more liquidity and control you give up. So retirement income planning is about finding the point of balance: enough certainty to sleep, enough flexibility to adapt, enough growth to fight inflation, enough liquidity to handle life, enough legacy if that matters to you. The best plan is not the one that sounds smartest in a debate. It is the one that allows you to live through retirement with security, flexibility, and a clear understanding of the trade-offs. That is what a good retirement income strategy should do. It should not sell fear. It should not sell certainty where certainty does not exist. It should show the system clearly, then let you decide what risks you want to keep and what risks you want to transfer. That is how I would approach the annuity versus portfolio decision: calmly, mathematically, personally, and always with the understanding that in retirement, income structure matters as much as portfolio size.